Welcome back. You're watching Editors Roundtable, and we have a guest now, Gautam Dugar, Head of Research at Institutional Equities with Motilal Oswal is with us now. Gautam, thanks a lot for joining us and coming to our studios for our show. So, earnings season ends next week. To you, I mean, what's been the key highlight? More upgrades or more downgrades?
So Anuj, this earnings season has been kind of even Stevens. You can evaluate it in two buckets basically. If you look at aggregates, your aggregates are giving a very different picture because two or three big companies have missed expectations, which is Reliance and Tata Motors. So if you look at the numbers which have been delivered so far, Nifty growth is tracking at 13% versus expectation of 23%. But if you look at the spread of the earnings, it is very good. 70% of our coverage universe has either met expectations or have beaten expectations. As far as upgrade to downgrade ratio is concerned, it is 1:1. We have seen about 45 companies earnings upgrade of 3% plus for FY23 and roughly 46, 47 companies where we have seen a downgrade of similar magnitude. So net we are still at 855 rupees of EPS for Nifty FY23 and about 1000 rupees for FY24. When we started the quarter, it was at 865 and 1006 rupees. But all of this has come from financials.
Some earnings are worth more and some earnings are worth less for market, right? I mean, when you give them P multiples.
Yes.
So what does this mean for, the earnings upgrades and downgrades? Net, what is the impact in your assessment to where index levels will be?
So quality of earnings is improving. Essentially, sectors with higher ROE are meeting expectations. So for example, if you look at the earnings which has come up so far, and if you keep financials aside, the earnings are flat, right? So cement earnings are down YOY, metals it is down, auto it is down, and all of this is in line with expectations because they were expected to decline on a YOY basis. Financials has been rock solid for last 4 years now. I mean, from 450 billion numbers in Nifty profits in BFSI in FY18 to 1.5 trillion in FY22, and now we are tracking 1.9 trillion for FY23. It's been phenomenal run for banks, both on P&L as well as on balance sheet. 2 years of pandemic, we have not seen any dislocation in financials earnings. Secondly, consumption is coming back in terms of earnings. If you saw some of the results, there has been not a single company which has reported a volume decline despite rural slowdown, inflation being so high. So consumption stocks have already time corrected for last 2-3 years. And then IT, which has remained fairly muted this quarter. But if you see IT from a slightly longer term picture, in the last 5-6 years, 5 IT companies put together have together delivered a profit of 5 lakh crores. And 80% of that has been returned back to the shareholders. That is 3.8 trillion. So while quarterly noise is very high on IT, but if you step back and look at a slightly longer term picture, IT earnings have also been very stable over the last 2-3 years. So that is where we stand. Numbers have been slightly below expectations if you look at the aggregates because 2 or 3 heavyweights have disappointed. But in terms of the spread of the earnings, numbers are fairly okay.
Gautam, the big theme this quarter was the hit on the margins. Across the board, we've seen big margin hit, but a lot of this was maybe looking behind because commodities have fallen, crude has fallen. So in that context, everybody's expecting the second half to be better. But within that, any sector do you think will see a big surprise in terms of earnings rebounding or the margins rebounding?
So I think there are 2 or 3. Most of the sectors should see a sequential margin improvement because Nimesh, crude oil prices are down from the peak, and so many other industrial commodities are also down 20 to 30% depending on where you look at it. So sectors like cement, auto, consumer, even pharma for that matter, all of them should show a sequential rebound in margins. On a YOY basis, it will depend on what the base is in terms of margin, but sequentially, if you look, it will get better and better.
What sector you will bet on? If you're saying these are the 4-5 sectors which will see a bounce back, within that, any particular sector that you guys are betting on big time that you'll see a sharp up move in terms of margin improvement and as well as volume improvement?
Yeah, Gautam, are you all in the camp that believes that cement will bounce back? Because that's the sense you're getting. As you said, input costs are cooling down, demand normally bounces back, and volumes will pick up as well. And those stocks are still, 15-20% away. I mean, I'm talking about the large cap ones. The mid caps are 40% odd away from there. So would that be a theme that you will play?
Yes. So we think that cement sector's EBITDA per ton will bottom out in September.
Okay.
Right. So things may look slightly worse in September compared to June, but that will be the bottom quarter if current commodity prices are anything to go by. The other 2 sectors, just to stress on, one is auto, where supply has improved significantly in the last 2 months on semiconductors. Demand has been very stable for 4-wheeler and CV cycle. And you've seen the commodity prices even for autos have come off. Plus they've passed on prices. So consumer will also benefit because the spillover effect of price impact will be felt in July to September quarter. And there also the commodity prices have come off. So these two sectors should definitely see a very significant improvement in margins as we go forward in September 22 and subsequent quarters. And of course, cement, as I mentioned.
So Gautam, stock ideas, and what are your top picks now, looking at the earnings season, where you believe that not only are the earnings good, but the outlook is also very good?
So, Anuj, first obvious thing that comes to mind is financials, and within that, large caps. The large cap financial earnings have been extremely strong.
So ICICI Bank or something else?
ICICI Bank, of course, is a consensus choice, whether you look at the sell side or a buy side. But aside of that, things like SBI, in fact, IndusInd delivered a very strong quarter this time. Some of the other non-banking financial names like Bajaj Finance, Cholamandalam, and even some of the gold finance companies have come up with good numbers. I think with market volumes picking up, the non-lending financials also should do well, which is things like Angel, ICICI Securities. Insurance, if you look at insurance, SBI Life remains our top idea. It's part of our model portfolio. So financials is a one cohort where we have the highest overweight. Then we like, as I said, auto, consumer, and IT. Within consumption, in staples, we have preference for Hindustan Lever, GCPL. And in discretionary, Titan has been a long-standing favorite for us. And then QSR segment has done exceedingly well. If you look at the performance of Jubilant, Devyani, Sapphire, I mean, they are firing all cylinders. Number of stores expansion, the delivery on the dine-in has come back to pre-COVID levels now. And then you have to pick and choose between the other sectors. So IT remains an allocation sector for us. Though the overweight has come down a little bit, we have made mid-cap IT zero. But our overall overweight on IT still remains about 200 basis points.
Gautam, I saw an interesting upgrade on Jubilant from your team. If you can just quickly run through why you guys like Jubilant Food.
And why is the stock not rallying? I mean compared to, it's still so much away from its high.
Yeah, I agree. So, Anuj, last year when there was a lot of hype around, the listing of Zomato, Jubilant had ran up significantly from a price of 2,700 to 4,500, if I remember right, from July to October. And valuations had gone up to 80, 85p, which clearly were not sustainable. So from there, it came down by about 45-50%, and now it is back up by about 20-25%. So why we like it is three reasons. It has a significant first mover advantage when you compare the number of stores that they have versus the other QSR peers. They're way ahead. Second, it is the only QSR company in India which has a consistent track record of delivering profits every year for last 12 years and growing at a ROE upwards of 20%. We think the opportunity for the entire QSR segment is very high. But within that, we think Jubilant is slightly ahead of others, and which is why it is part of our model portfolio.
One likes the pizza also, right?
Exactly.
Thank you so much for coming in. It's a pleasure having you with us here. And once again, thank you very much. Well, I think that's it from all of us here on this edition of Editors Roundtable. Thank you very much for watching. All of you have a very good weekend. So will we. See you back fresh and early Monday morning. Thanks for watching. More coming up on the other side.